Welcome back to Cherry Beckert's Private Client Services podcast channel. I'm Marcy Spivey, the leader of our Private Client Services group, and I'm very excited to welcome our speakers today for the second episode of our 3-episode podcast series for closely held businesses. Today, we are diving into a crucial topic for business owners, exit planning, and understanding the value of your business. Can you all introduce yourself today?
Thank you very much, Marcy. Yeah, I'm Dave Nissen, partner at Cherry Bekaert, and I've been practicing for over 40 years dealing with closely held business owners. And this is I'm really excited about being on this podcast today.
Hi, this is Kyle Nevins. I'm a partner in our transaction advisory practice, focused on transaction tax. Look forward to speaking at one. Thanks.
And I'm Jessica Fairchild, a co-founder and partner at Croke Fairchild Duarte Beres. We're a law firm with headquarters in Chicago. I have been practicing a while myself, been doing this for 24 years, and my practice largely focuses on mergers and acquisitions and corporate transactions, and I do sell side and buy side work, and thanks for having me on, and glad to be here.
This is really a great series that we're doing, and this part in particular is really, really important because it talks about valuing your business. So I guess the question I want to pose to you, Jessica, is why is it important for a business owner to value their business, even if they're not really planning on exiting it real soon?
Yeah, I think that's a great question and have a few thoughts on that, Dave, from my years of practicing in this space. The first I will say is because we are in an environment where there's a lot of unsolicited offers coming in. I represent a lot of clients, and private equity strategic buyers are often knocking at the door even when the founder seller group is not looking to sell. And so to be able to react quickly to those opportunities, which may be a no, but might be I'm interested, let's talk further. I think it's a good idea for founders, seller groups to have a consistent idea sort of on a regular basis of what do they think the value of their business is, right? If there's a good opportunity that comes knocking, as it turns out, and you're not prepared to move quickly to respond to it, that can be really a lost opportunity. So staying up on value, just to be able to react in the market is good. The second reason I think it's good to have a value, sort of an ongoing understanding of your values, just that, many sellers do want to sell, and they're reliant on their business for generating their income and sustaining their lifestyle. So having an idea of what is the real value of your business can really help you with a view towards when you sell and maximizing that value, what do you need to sustain your lifestyle and your ongoing income really gives you a sense of, am I ready to sell now? Is this the price I want to sell at, or is there a future price? So staying up on that can really help you plan. What do I need for the future? And when might I be ready to sell? And the third reason I would say, know your company's value is because even if you're not planning to sell today, it's good to prepare for a sale. And we'll probably talk about this and have talked about this in the past, but often it takes time to get ready to sell. And there are a lot of levers you can pull in your business even to maximize value for a sale. If you're starting planning 1, 2, 3 years ahead, you can work with a valuation experts to understand how is the market viewing your business, what are the weaknesses that might be there, what are the gaps, and you can really plan ahead and say, okay, I have a 3-year exit timeline. Where am I sitting today? What is causing me to be at that value? And you can really drive your business in certain ways to maximize and be ready when you get to that 3-year period and you're ready to go into the market. So all of those are reasons, to stay up on value on kind of a regular basis, even if an exit isn't in the short-term time horizon. And I'd love to hear if, Kyle, if you have any other further thoughts on that.
Yeah, I mean, I think, taking a step back a little bit, I think it's always helpful to understand what your company's worth. And it's really something that, at a high level, I think management teams should always be aware of. I think obviously, one, it really just helps you plan for the future and really not only from a personal perspective, but also from a business standpoint. And if you have management teams who, have their goal to sell at X and, they're not quite there yet, then the question might be, what do we need to do to get there? So it's something that I think not only drives the potential value on exit, but also, can help drive the operations and the activities within the business itself on a go-forward basis.
Really, really good answers. And Jessica, you brought up one of the reasons is you really could get a handle on what you're earning, what the income is of the business, what the true income is. And when you're valuing a business, it really starts with what is the true income of the business. And closely held businesses, as both of you know, really they really focus a lot on tax deductions, and being able to whittle down their tax obligation. And I think when you sift through and you look at what the true income is, which is really driving the value of the business, that kind of helps determine kind of where they're at, which will help them plan, like you said. So Kyle, how does someone go about valuing their business? If you can maybe add a little bit more to that.
Yeah, no, thanks, David. So, generally we see a lot of business owners either taking sort of a word of mouth approach where they're looking at, discussions they've had with folks outside of their business, others in the industry or similar industries. It might say, oh, we heard this company sold for X, so we might be able to get something greater than that or something similar to that. Or, we oftentimes see management teams who will do their own, internally prepared valuations, whether that's, the CFO or they have somebody in corporate development, whatever that might be. But presumably, oftentimes just the founders are trying to figure out based on their own valuation models what their company might be worth. Given that in mind, I think what we usually see being the most effective is to really try to work with some sort of third-party valuation consultant who can, take management's knowledge of the business and match that up with kind of best practices from a valuation perspective to really bridge the gap and try to get to what a potential market value might be for the company. And, outside of the actual valuation exercise itself, I think some other things that generally are going to go into determining the value are going to be understanding the type of buyer that might be coming in, whether it's a strategic or whether it might be a private equity sponsor or platform company. And also just really understanding the company's underlying financials and looking at it from an EBITDA perspective, which is where most buyers are probably going to be looking at valuing the business. And then also understanding the tax classification and the anticipated structure. For example, if it's a transaction that's going to give rise to a tax basis step up, that might be more valuable to a buyer than an otherwise transaction that otherwise wouldn't give such value. So again, there's different methodologies. There's just different things to think about outside of pure valuation. Jessica, let me know if you have anything else to add.
Yeah, I think that was spot on. Getting experts to help with the valuation work. We see it, that can come in a form of an investment banker who's hired to potentially sell a company or just a standalone valuation expert. I will say that getting somebody who has familiarity with doing valuations in the M&A context is particularly important. There's obviously a lot of reasons to get valuations. People get them for gifts, other reasons, and they're great valuations. But really getting someone who knows the M&A market, who understands multiples and drivers for M&A, and like you said, the differences that buyers will place on different factors, I think is really key there.
Yeah, really, both of those are great answers. But when you do evaluation, part of the exercise is looking at the market. Looking at some sales that might have happened in the industries, and I think that's a really important component of it. So let me ask you another question. You had mentioned some of the different approaches for business valuation. Kyle, did you want to just expand on that a little bit?
Yeah, thanks. So I think two key approaches you're looking at doing a formal valuation are going to come in the form of either looking at the income approach or looking at the market approach. And I think on the income approach side, you're generally going to be looking at the expected future cash flows of the company, which generally going to be discounted to a present value based on some sort of agreed upon reasonable rate of return. And then from a market approach standpoint, you're generally going to be looking either at public company data that may be available to get a sense of potential revenue and EBITDA multiples that should get used, or looking at similar transactions where you're basically looking at implied multiples from other recently closed transactions, whether it's similar size companies or similar industries, or whatever that may be. And again, obviously, those are sort of the valuation approaches, but I think the other thing here too is going to be, as you're going through the sale process, does it make sense to also talk to your tax advisors? Does it make sense to talk to, financial advisors, whether it's a sell-side QB provider or somebody that handles tax matters and tax planning to really understand, do you have your ducks in a row and can you do some additional work up front ahead of a potential sale to help drive that value and help really put you in a position where you can get ahead of any potential issues once a seller eventually comes in, or once a buyer eventually comes in, rather.
Kyle, before I turn it over to Jessica, can I just expand on something you had said? I want to ask you a question.
Sure.
So you had said earlier if it was a stock sale or an asset sale. So talk briefly a little bit between the difference between the two, and will the price be adjusted if one or the other was selected, and why would that be?
Yeah, so when you have a company that's being sold, you generally can either have it be structured as a sale of equity or sale of stock, or you can have it be structured as a sale of assets. Generally speaking, if you have a sale of equity, if the target is a corporate entity, then that would not give rise to any potential step up to the buyers. However, if you have a true asset sale, or if you have what could be treated as a deemed asset acquisition, whereby if you have the sellers, let's say an S corp, and they structure it in certain ways where you could get a step up, or if you have a partnership or an otherwise disregarded LLC, where you may actually legally acquire the equity, but for tax purposes, there's this fiction where effectively you're going to be treated as deemed to acquire the assets of the company. And generally, we see buyers place a decent value on that, obviously depending on the buyer, but to the extent that they're able to take advantage of potential goodwill and amortization and potential depreciation deductions post-closing, that generally does give rise to a significant, in certain cases, increase in value that the buyer may place on the company. Jessica, do you have anything else to add?
No, I think that was a great answer. I think you really honed in on an important thing, that planning from a seller's perspective is extremely important, right? The outcome to a seller, depending on the actual structure of the transaction, could be quite different. So paying attention to that if you're a seller, and getting the right team around you to advise on how things might be changed from what a buyer is thinking to be advantageous to a seller can have a lot of impact, particularly on taxes and just the ultimate value that hits the pocket of the seller. So that's really important.
Great answers. Jessica, I'm going to ask you this. What are some of the key factors that impact a business valuation?
Yes, it's a great question. Again, you hit it earlier, Dave. Income, right? Income and the financial performance of the business. That's the largest driver of valuation. But I will mention a couple other things just that we see as M&A lawyers who have over the years seen, strong markets for M&A, less strong markets. And I kind of think of them as sort of external and then internal to the actual company. So on the external side, the factor of what's going on generally in the M&A market has a lot of impact on valuations. So if there is a favorable M&A market kind of going on, you're going to see multiples going up, maybe surprising multiples. And things that affect M&A climate are, interest rate movements generally, the IPO market, believe it or not, because if companies can exit through IPO, then they've got funds to put back into doing transactions. And then just other political and economic factors. Right now, we're looking at the tariffs, plan out of the federal government out of Washington is scaring off some deals. I have a seller who's waiting to move on an LOI, and the buyer is waiting to see what transpires with the taxes. So just general, economic and political actions and how they affect the M&A environment, though not specific to your company and something you can do, do impact multiples and the valuation. I will also say on that point, what industry you're in might have a lot of impact on valuations at a given time. And I think you guys know this, and being in the accounting space, there often are hot industries where we're seeing deal flow be strong and multiples sort of jack up because there's a lot of interest from buyers. And so while that, again, is not about things you can prep in your business, it may be, if you've been taking a wait and see approach, it may be the right time to move into a sale process if your industry is one that is seeing a lot of activity, because it might be impacting your valuation. So those are a couple of the, unfortunately, sort of external factors that folks don't have a lot of control over. I will mention a couple other quick internal factors as well that are about your business that are, again, non-financial that we've seen. And number one on that list for me is, what's the role? Are you a founder and owner group that's going to stay in the business? Certain buyers, put a premium on having, a transition period or some staying power for sellers. They want them to be involved in the business, maybe longer term, maybe shorter term. And, sometimes we'll see situations where a founder in particular is not able, due to health or other reasons, continue on, or just is really adamant about not doing that. And from buyers' perspective, that can have a lot of impact. They want to make sure they understand how to run the business and grow the business, and they may really need a founder there. So we see that impacting deals, and I think, buyers' willingness and interest in a deal. And the last thing I'd mention is just contingencies in your business, right? The better approach is to sell your business where there aren't any potential contingencies, like litigation, for example. We also see pension withdrawal liabilities, sort of other things where if you can kind of sell your business where there aren't those sort of outstanding contingencies that a buyer has to sort of bake into their planning, that can go a long way to getting the highest valuation. And it's just another reason to sort of, if you can, be in a position to control when you might exit and not be doing it when you haven't sort of planned and made sure you're selling at the high point. So those are a couple of the thoughts I had. I'd love to hear, Kyle, if you have any additional thoughts around that.
Yeah, no, I appreciate it. I think, there's a lot of factors that are obviously going to impact the valuation. I think, of all the drivers, in general, we're seeing, the company's growth, both the history of growth and the prospect of growth going forward, the margins at the business level, and I think other key financial results, namely based on EBITDA, are often kind of the primary indicators of value. I think it's important that, the management team, feels comfortable with their view of the company's growth and margins and EBITDA and other kind of key metrics from a financial standpoint, as well as an operational standpoint, so that once, they are in a position of going to market and having buyers coming in and poking around, that they feel comfortable that those viewpoints and those historicals are going to stand up to advisors coming in and poking around in more detail. So with that, it's covered it all.
That sounds great. Unfortunately, the way it works in the world of value is sometimes the best time to sell is when things are at the best. And that's probably the last time, the least of the times that you really want to sell, but it's when the value's the highest. It's kind of like the stock market. People never want to sell when the market's high, but that's the time you really want to sell. Most people want to sell when the market's low. So it's kind of the same dynamic. Kyle, I'm going to ask you one last question, and then we'll hear Jessica's answers on it too. But there's a lot of do-it-yourselfers out there. So why would a business owner want to consider obtaining a professional valuation, like one prepared by Cherry Bekaert professionals, rather than just doing it themselves?
Yeah, I think at the end of the day, the management team is generally going to know their business the best. So I think there's a propensity to often try to do the valuation themselves as well. But I think while they may have the inherent knowledge of the business and the day-to-day, I think there's often a lack of resources as they're required to run and operate their own business. And I think there's other times a lack of expertise, and in terms of how to translate that knowledge of the business and the historical financials into a reasonable valuation and an indication of value that a potential buyer may also agree with. So while it's certainly helpful to have management involved, I think having a valuation professional who can effectively kind of bridge that gap between the management team and what a prospective buyer might look at in more detail is certainly something that should be considered, along with not only valuation people, but also getting the right tax advisors and the right financial advisors as well, to really, not only understand the value of the business, but what that means to the sellers, both throughout the sale process and on a go-forward basis as well. Jessica?
Yeah, I agree with that. I think, and we kind of hit this earlier, knowledge about your industry and the market. A lot of this is driven by multiples, and you see that moving around different by industry and then just how the market's doing. So also getting that outside point of view when someone comes in to do the valuation work to help you understand fully what's going on in your industry, what's going on in your market, what do multiples look like. They do affect valuation, and as a seller group or founder, you may not have access to that information or that level of detail. So I think somebody who can bring that perspective as well. Oftentimes the founder and management team don't have that. And then, we see a lot where we'll do sell side processes, and there's always a question about whether that group gets their own kind of QV. Kyle, you do a lot of QV work, you mentioned as well. And there's always a debate. Do we get our own QV if the buyer is just going to go do their own deep dive on the financials? And I think, getting an expert in to really dive deep into your financials and understand where the buyers are going to find issues is valuable. That leads to, I think, better discussions on the valuation and just hopefully a better outcome for the seller group in the long run.
Agreed. Appreciate the plug. I think certainly, anytime you can get ahead of potential issues in a sale process and, avoid headaches as you go further along in the process, is certainly going to be good for everyone, and, keeps a better relationship for all parties involved on a post-closing basis as well. So couldn't agree more.
Well, Jessica, Kyle, I have to tell you, thanks a lot. These were great conversation, great dialogue, and I learned quite a bit talking to you, both of you today. So thank you very much.
Thank you for tuning into today's episode. Don't forget to subscribe to our podcast channel for more insights and advice on managing your business effectively. Until next time, I'm Marcy Spivey, and this has been Cherry Bekaert's Private Client Services Podcast. If you have any questions or need assistance, do not hesitate to reach out to our team.